This is the Lex Beyond podcast by Lexicon Labs. I'm Lex.
And I'm Bianca. Welcome back to the Deep Dive. Today, we are undertaking an analysis that, I have to say, feels incredibly urgent. Foundational, even.
It really does.
We're sifting through a stack of research that challenges the very language of finance. I mean, it argues that one of the most accepted terms in the investment world is not just redundant, it's actively detrimental.
And it's a deep dive that couldn't be more timely. You know, with the recent passing of Charlie Munger, the world has spent months re-examining the bedrock principles he and Warren Buffett champion.
Right. His influence is just indelible.
It is. And it gives us the perfect moment to scrutinize the terminology that has grown up around their philosophy. Specifically, that phrase, value investing.
Okay, let's unpack this then. The source material we're using, it's a comprehensive survey of contemporary value investors. It was compiled by Lexicon Labs, and it focuses heavily on the insights and legacy of figures like Seth Klarman. But it suggests that the term value investing is, and I'm quoting here, a dangerous myth, a financial misnomer.
That's the core thesis, this research. It refers to the clarity around this distinction as the linchpin.
The linchpin.
The linchpin to understanding what genuine investing truly is. So our mission today is to really get into this specific argument that value investing is redundant, it's fundamentally incorrect, and that its prevalence has allowed for just a massive conceptual distortion in modern financial thought.
The central paradox here is just astounding when you think about it.
It is.
The titans of the field, I mean, you're talking Ben Graham, Warren Buffett, Charlie Munger.
Founders.
Yeah.
Mount Rushmore of this philosophy.
Exactly. They did not view themselves, nor did they refer to themselves as value investors.
Right.
And yet this term has become the default definition for their approach. It's created this conceptual vacuum that allows things like, crypto speculation to be confused with true capital-preserving investment.
And we're not just talking about academic debates. We're investigating the history of semantics that, at the end of the day, has trillion-dollar implications. It touches everything from university curricula all the way to SEC litigation.
So if we can redefine what investing means.
We can redefine market participation. It's that big.
So let's jump right into the core thesis. The source material calls this the monumental paradigm shift. And this is the idea that recognizing the redundancy of value investing, it isn't just a vocabulary tweak. It completely reshapes the world of finance, from academic theory straight through to how markets are classified.
Absolutely. The source argues that for those who are really immersed in finance, this is a truly transformative moment. That phrase, value investing, it might seem purely semantic, just words.
Sure.
But the source describes accepting its redundancy as the gateway to a much cleaner, more rigorous, and you could argue a more correct understanding of original investment principles.
So it's a shift from
Right.
a fragmented view to a more holistic one.
A shift from a segmented, fractured view of capital allocation to a holistic one.
Exactly. And I think the sheer persistence of this misconception, the fact that value investing is so deeply entrenched in academic programs, in the media, in every financial news headline.
It's everywhere.
That actually underscores the magnitude of the shift that's needed. It's like discovering that for 50 years, the common term for gravity was actually, heavy falling.
Right. It takes real institutional effort to correct that.
A huge effort.
It does. And that institutional resistance is where the size of the required paradigm shift really, it just amplifies. If major institutions and fund managers and textbooks are all categorizing a type of investing as value investing, then the world is implicitly accepting that there must be other non-value types of investing.
Of course. It's a logical necessity.
It is. So the change required is not just swapping one word for another. It's about discarding an entire category that has been used to structure portfolios and research.
So let's really nail down the redundancy argument itself. What is the logical flaw that the source identifies?
The argument is stunningly simple. The source basically says that the word value in value investing is redundant because, by the simplest, most rational definition, all good investing, it inherently seeks value sufficient to justify the price paid.
Meaning, if I pay $100 for an asset, I am, by definition, an investor only if I believe that asset is worth at least $100, and hopefully more, right?
Exactly. When you deploy capital, your intent is to earn a return on that capital. That's the whole game. And that return is only possible if the future stream of benefits, cash flow, the growth in its intrinsic value, exceeds what you paid for it. If you're paying a price for an asset and you do not believe its intrinsic value is sufficient to justify that price, then what are you doing?
They're speculating.
You're engaged in an act of faith or hope or speculation, but you are not investing. Therefore, value is inseparable from the concept of investment itself.
And this sets up the ultimate conclusion reached by both Buffett and Munger. This idea that all investing is value investing, by definition.
Yes. There simply is no other valid kind of investing.
And this philosophical clarity, the stripping away of the qualifier, this is what the source material is really pushing for.
It is, and it's not just an intellectual exercise.
Yeah.
It immediately clarifies what belongs in an investment portfolio and what absolutely does not.
Okay, so if this conclusion is so logically sound, and I mean, the argument is almost irrefutable when you phrase it that way, why has the myth of value investing persisted so powerfully for so long?
It's a great question.
The source material offers two key reasons. One has to do with sort of public effort, and the other is about intellectual oversight.
The first reason, as the research identifies it, is rooted in what you might call intellectual apathy.
Apathy, okay.
A significant segment of the investing population just hasn't made the fundamental effort to truly understand the essence of capital allocation.
Yeah.
They accept the prevailing market narrative.
The one that's pushed by promoters, the media, academics.
Right. A narrative that benefits from segmentation. Easier. They go along with the crowd because, frankly, questioning core definitions is mentally exhausting.
That's understandable for the general public, I guess, but the source suggests there's a much bigger and kind of more ironic reason that involves the very people who should know better.
Yes, and this is where the critique gets really sharp. The larger reason, according to the research, is that highly brilliant minds, we're talking about individuals who dedicate vast amounts of time to financial thought, research, and analysis. The pros. They nonetheless fail to draw the final, obvious conclusion that value investing is fundamentally a misnomer.
Hold on, for a man managing billions of dollars and writing these seminal prefaces, isn't calling that an intellectual oversight a bit harsh?
It sounds harsh, yeah.
Could it be that they just use the phrase because it's useful shorthand? You know, for differentiation in the market, even if they know it's redundant deep down.
That is a crucial point, and the source does address it. And while shorthand is convenient, the consistent high-volume use of the redundant term by thought leaders like Seth Klarman doesn't just simplify, it legitimizes the underlying logical fallacy.
It gives it a stamp of approval.
It does. They become so focused on applying the techniques associated with value, like, deep due diligence, finding specific discounts, quantifying the margin of safety, that they forget the overarching philosophical truth.
Which is?
That these techniques are simply good investing. They're universally applied, where they should be.
So the paradox is that these brilliant practitioners, by sticking to the term value investing, they actually solidify a myth that the very founders they admire, Graham, Buffett, Munger, explicitly rejected.
And the consequence of that intellectual oversight is the creation of this massive gray area. If they'd consistently insisted we are just investors, full stop, there would be no conceptual room for a supposed opposite category of investing to emerge.
And the stage is set then for the major real-world consequence. The blurring of the line between genuine investment and pure speculation, a line that should, by definition, be razor-sharp.
It should be a bright line, and it's not. So if we follow that logical progression from the first section, where we establish that all investing must seek value,
right,
we immediately arrive at the modern consequence of this conceptual confusion. Because the definition of investing has been qualified. It's been narrowed to value investing. A vacuum was created.
And into that vacuum rushed other non-value-seeking activities.
Exactly. They snuck in under the investing umbrella.
And the primary test case the source material brings up for this definitional failure is the rise of alternative assets, specifically Bitcoin and the broader world of crypto.
Yeah, the elephant in the room.
Right. So in the source's proposed correct understanding paradigm, the very idea of discussing Bitcoin in the context of genuine investment is immediately excluded.
The exclusion is categorical. It's absolute. And it relies entirely on the classical definition of intrinsic value that was favored by Graham and Munger. The source states unequivocally that Bitcoin, or any similar asset, should not belong to a balanced investment portfolio.
And it shouldn't even be discussed in the same sentence as genuine investing?
Not even in the same sentence.
And the foundational reason for this very strict exclusion is the absence of cash flows. The source argues that if an asset generates no present or future cash flows, its intrinsic value, from a business ownership perspective, is zero.
That is the ultimate firewall for the Graham and Buffett school of thought. Intrinsic value in classical finance is the discounted value of the cash that you can extract from a business or an asset over its remaining life. Simple as that.
A stock's value comes from dividends and retained earnings.
A bond's value comes from coupon payments. A property's value comes from rent. So the question is, what cash flows does a purely decentralized, non-productive token generate?
None, unless you count the possibility of selling it to someone else for more money down the road.
Precisely.
Yeah.
And that is the definition of speculation, not investment. That lack of productive capacity is the definitional break. The source acknowledges that people are drawn to crypto for speculative gains or maybe for some perceived utility as a transactional currency.
Sure.
But it insists that true investors must maintain a cautious distance. The moment you define investment correctly, the motive behind buying assets like Bitcoin shifts from investing to speculation.
And this requires us to dive into a really clear definition of speculation. The source pulls it directly from the framework in the 7th edition of Security Analysis, the very work that Klarman edited. So what's the line that separates the two activities?
Well, the line as articulated by Graham is stark, he said. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return.
Okay, so thorough analysis, safety of principal, satisfactory return.
Right. Then he says, operations not meeting these requirements are speculative. The critical component there is the thorough analysis based on measurable underlying value.
So when looking at speculation specifically, what are the criteria used in the source material to identify it?
The definition is crystal clear. Items that generate no present or future cash flows and whose values depend entirely on buyer whim should be regarded as speculation. Their value is determined purely by market psychology.
The hope that tomorrow the herd will be willing to pay more than I did today.
That's it. Not because the asset has become fundamentally more productive, but just because sentiment has changed.
The source provides a useful, if maybe a little controversial, list of examples that fit this category. It shows how varied yet fundamentally similar these speculative assets are.
It's a great list. It includes things like high-end art, rare stamps and coins, fine wine collections,
And NFTs,
and of course, alternative currencies like crypto. And while these objects might have cultural value or personal value, they all share that one trait. Their financial value is based purely on rarity and shifting emotional or market trends, not on cash flow generation.
So a genuine investor focused on intrinsic cash flow-backed value just maintains that distance.
They have to.
So if the difference is so clear in principle, why does this matter so much to the wider economy, especially when you get into regulatory issues that govern the financial landscape?
Because this semantic error, it has massive structural consequences. The source argues that this conceptual confusion around value investing connects directly to the fate of a trillion-dollar economy and to ongoing issues that are being heavily litigated.
Specifically around whether certain digital assets are or should be regulated as securities?
Exactly. And the source finds the prospect of Bitcoin being characterized as a security increasingly plausible.
Why is that conclusion becoming so compelling when you look at it through the clarity of this classical investing paradigm?
Because the classical paradigm brings the focus back to the investor's intent and the asset's actual nature. If you eliminate the phrase value investing and just ask, is this investment? The answer for Bitcoin, based on cash flow, is a definitive no. But the moment the public starts using the word investing for these assets, they open the door to regulatory scrutiny that's designed to protect investors.
Okay, so let's transition now from the consequences of the myth to its origins. The established narrative, the one we all grew up reading in financial texts, is that Ben Graham is the father of value investing.
Right.
And that Buffett and Munger are the greatest value investors of the last half-century. I mean, this lineage is sacred in finance.
It is the standard storyline. It's reinforced by everything from Investopedia entries to the names of elite academic centers like the Heilbronn Center for Graham and Dodd Investing at Columbia. It's an accepted historical fact.
But the crucial insight from our source material centers on the lack of scrutiny that's been applied to the primary sources. Everyone repeats the narrative, but it seems like very few people have gone back to check what Graham, Buffett, and Munger actually said or wrote.
And when you filter that historical narrative through the joint lens of history and strict financial logic, the results are, as the source states, unequivocal and markedly different.
And that difference is?
These three financial titans did not perceive themselves as value investors. They simply saw themselves as investors, full stop.
And this isn't just about semantics, is it? This completely rewrites the history of modern finance, and crucially, it removes the intellectual armor that later practitioners use to justify their own approaches.
It really does. Let's start with Ben Graham, the supposed father. It is undeniable that he pioneered the principles of security analysis and the margin of safety.
Of course. And his masterpiece, The Intelligent Investor, even ships today with the subtitle, The Definitive Book on Value Investing.
Right. It's right there on the cover. So, given that context, the source uncovered a genuinely shocking fact about Graham's original writings.
Which is?
The source confirms through textual analysis that Ben Graham never once used the phrase value investing in his two seminal foundational works, The Intelligent Investor and Security Analysis.
Wait, never?
Not once. Think of the irony. The acknowledged father of the philosophy never uttered the name of his own supposed creation in the books that defined his entire career.
That immediately suggests that the term was a later invention, a convenient marketing label that was just grafted onto his legacy.
It has to be, and the historical timeline confirms this.
Right.
The source notes that the phrase value investor is nowhere to be found in any of the original editions of The Intelligent Investor published during Graham's lifetime. So that's 1949, 1954, 59, 65, all the way up to the final edition before his death in 1976. The term, therefore, entered the lexicon posthumously.
Okay, so this leads us directly to Warren Buffett. You might assume, as the great communicator of Graham's ideas, that he must have been the one to popularize the phrase in his early writings.
Well, he did use the phrase value investing. He used it 3 times in his renowned 1984 article, The Super Investors of Graham and Doddsville.
Okay, so he did use it.
He did. And this piece, it was published in a Columbia Business School magazine, and it was an effort by Buffett to showcase the enduring relevance of Graham's teachings. He was demonstrating that several investors who applied those principles had achieved these exceptional market-beating returns.
And this article is the suspected source of the contagion, correct?
That's the source's hypothesis. The Super Investors of Graham and Doddsville later became a famous appendix in the 1986 revised edition of The Intelligent Investor.
I see.
And the source posits that the publishers, recognizing the success and fame of Buffett and needing a succinct way to classify the book for a wider audience, just seized on the term value investing. It was a catchy, made-to-order marketing phrase for a philosophy that, up until then, had no specific name.
It's the ultimate example of a label overriding the philosophy. But the most crucial clarification about Buffett, it comes not from the single article, but from his sustained decades-long record of direct communication with shareholders.
That's right. If Buffett had truly adopted the label value investing after 1984, you would expect to see it consistently in his annual investor letters, which are basically his living record of financial thought.
But the data shows. What?
The data reveals he used the phrase only twice in his investor letters, once in 1988, and then critically for the last time in his 1992 letter.
And what did he say in that 1992 letter? This feels like the moment where Buffett explicitly set the record straight decades ago, and yet the financial world largely just failed to listen.
He was incredibly clear. In the 1992 letter, Buffett made an unequivocal statement. We think the very term value investing is redundant.
Redundant.
Redundant. He then provided the full logical argument. He asked, what is investing if it is not the act of seeking value at least sufficient to justify the amount paid? He then drew the line even further, arguing that consciously paying more than calculated intrinsic value in the hope of selling it to a greater fool should be labeled speculation.
That is a fundamental denouncement of the term that the financial world uses to define him. He called it redundant and explicitly framed the alternative as speculation.
Couldn't be clearer. And Charlie Munger, whose recent passing gives us so much context, was completely aligned with Buffett and Graham. When asked about the future of value investing in public forums, Munger frequently denounced the term as a bad use of the language.
And his definitive statement perfectly mirrors Buffett's philosophy.
Munger's summation was simple. All good investing is value investing, by definition. This reveals the common core conclusion they all shared. The source emphasizes that the world describes them as value investors, and this label, this designation, it grants their modern successors intellectual armor.
It lets them leverage the celebrated legacies of these figures.
Exactly. But the crucial flaw is that the celebrated figures themselves rejected the very term used to define their cohort. It fundamentally dismantles the historical narrative that the financial community holds so dear.
It really does. This historical analysis brings us right back to the modern figure at the center of the source's survey, Seth Klarman.
Right.
As CEO and portfolio manager of the Baupost Group, he's overseeing over $27 billion in assets. He's known for his highly disciplined, cautious approach, and the New York Times rightly dubbed him the most successful and influential investor you have probably never heard of.
And Klarman is such a key figure because he embodies this paradox perfectly. He is intellectually aligned with the fundamental principles, the cash flow-driven, risk-averse principles of Graham and Buffett.
He's searching for mispriced assets, focusing on preserving capital.
All of that. But he nonetheless firmly embraces the very terminology the founders rejected.
And his book, Margin of Safety, Risk-Averse Value Investing Strategies for the Thoughtful Investor, is legendary. I mean, it's so scarce and coveted that it often trades for thousands of dollars.
It does. And the title itself centers the entire philosophy on that single Graham concept.
Margin of Safety.
And Klarman readily admits that he stole the title blatantly from The Intelligent Investor because it so perfectly captures what an investor, or as he would say, a value investor, tries to do. And he gives an excellent, rigorous definition of the concept.
Which is?
Leaving room for error, because you know you might be wrong, ensuring you are likely not going to be in tears. It is the essential buffer against the uncertainty of the future.
But this is precisely where the source material argues Klarman goes off course, despite his otherwise flawless execution of the strategy.
The error, according to the source, lies in the exclusivity. Klarman defines the application of the margin of safety as a practice that is exclusive to value investors.
I see.
And the source argues that this practice is what every genuine rational investor does anyway, regardless of their supposed style.
Let's elaborate on that universality. Why isn't the margin of safety just a value strategy?
Well, think about any major capital allocation decision outside of the stock market. If you are buying a business, you require a price discount, a margin of safety, below your estimate of its true earning power.
Of course.
If you're buying a house, you want the appraised value to exceed the price you pay, providing a buffer against market downturns or unforeseen repair costs. If you were truly certain of the outcome, say a short-term treasury bond, you would need a margin of safety. But nearly every other capital deployment involves uncertainty.
So, if you deploy capital without a margin of safety, you are simply being reckless. You're not pursuing a different type of investing.
Exactly. It's a requirement for sound capital deployment, not some niche philosophy. The source argues that by claiming the margin of safety as a specific attribute of value investing, Klarman inadvertently suggests that other types of investors, say growth investors, can rationally operate without a buffer against uncertainty.
Which is patently absurd.
It's absurd.
And this conceptual break is what creates that visual contradiction. The popular perception that Klarman is the heir apparent to the Graham-Buffett-Munger lineage. We see them grouped together visually and conceptually all the time.
And the source material is highly critical of this. It identifies this visual and narrative perception as a critical turning point for financial historians. It's the precise spot where the intellectual lineage got derailed.
And the source claims the power of this visual link is twofold.
Yes. Firstly, it locks in the misidentification of Graham, Buffett, and Munger as value investors, which we've already shown they rejected. Secondly, and more perniciously, by creating a perceived straight line from the founders to Klarman, it provides intellectual protection to Klarman and his cohort. It allows them to use the founders' success as justification for maintaining the redundant term. It suggests a direct conceptual inheritance where none exists.
Because the modern cohort uses the very language the founders repudiated.
Precisely. The assertion is that Klarman, despite his enormous success and intellectual rigor, stands apart from the traditional lineage precisely because he and his cohort embrace the value investing qualifier that the founders emphatically rejected as confusing and unnecessary.
Let's examine Klarman's own definition of value investing. He roots it squarely in Graham and Dodd. Right.
He does. He states that markets are inefficient, prices deviate from intrinsic value, and the job is to find deviations where price falls below underlying value, making them attractive.
And that definition is, it's unimpeachable.
It is.
But the source's point remains. The issue is qualifying the search. It implies there is an equally rational alternative that doesn't seek value, which, by the standards of Graham and Buffett, is just speculation.
And that one qualifying word, that's what unlocks the most damaging structural consequence for the market.
So this brings us to the real core of the problem, the logical and psychological effect created by using the term value investing. It forces market participants to draw a rational conclusion that structurally distorts the entire marketplace.
Right. If market participants, so fund managers, academics, retail investors, if you constantly hear about a specific niche philosophy called value investing, the rational, inescapable conclusion is that there must be other non-value ways to invest.
Of course. Otherwise, why would the descriptor be necessary?
Why would it be there? And the source material uses that simple, brilliant analogy to illustrate this point, the story of the child on the basketball team.
Right, I love this one.
It's perfect. Imagine your child comes home from practice and tells you there are some short kids on the basketball team. Your mind immediately jumps to the logical inference that there must also be some tall kids on the team.
Yeah.
If every child was short, the qualifier short would be meaningless.
Huh.
The child would just say there are kids on the team. The qualifier mandates a countercategory.
It's an essential human function. Language creates boundaries. And by qualifying the act of investing as value investing, proponents fundamentally diminished their own value proposition. And, as the source notes, they created fake competitors in the market.
And this is the largest irony of the entire debate. By attempting to differentiate themselves using this redundant term, these investors created the intellectual room for speculative activities and non-value-driven strategies to claim the title of investing.
So the source's summary is what?
The ultimate consequences. Speculation rose because investing was reduced to value investing.
And this conceptual segmentation is just incredibly pervasive. It creates the entire world of investment products you see today. Growth funds, momentum funds, quality funds, all built on the premise that there are distinct philosophies separate from value.
Which forces the essential question that the source material wants to ask Klarman and his cohort.
Which is?
If value investing is the one true path, what exactly are these other types of investing that exist outside the definitions of speculation like art and crypto and value?
And the usual answer, the most persistent fake competitor, is growth investing.
The old value versus growth debate.
Exactly. The idea that you buy high-growth companies at any price, anticipating that future earnings will catch up to and exceed the current cost.
But here, the source finds Klarman to be absolutely correct, and they commend him for it. He rejects the growth versus value narrative. He views it as a superficial segmentation created by index fund classification.
Right. Klarman stated explicitly that the academic definition of value, just buying the cheapest stocks by the numbers, misses the true point of Graham and Dodd. He said they were focused on earnings power and the growth possibilities in a business.
And he concludes with that critical statement. He says, "The way I think about the market is not that there are growth stocks and value stocks, but rather that all stocks may hold value."
He is 100% correct in that rejection. Growth investing is not a separate philosophy.
Not at all.
It is simply value investing applied with a longer time horizon and often a higher degree of uncertainty. You're anticipating future cash flows that justify a higher price today.
But the source argues he fails to follow this logic to its natural conclusion.
He stops one step short.
One step short. If growth investing is value investing in disguise, which it is, and everything else, art, crypto, NFTs, is speculation, which it is, then the word value is entirely redundant. There is only one type of sound capital deployment, investment, which is inherently value-seeking.
And to demonstrate the magnitude of this blind spot, the source provides a powerful data point regarding Klarman's usage rate of the redundant term in one of the most important financial documents of the last generation.
Yeah, this is a killer stat. In the preface to the 7th edition of Security Analysis, the great work of Graham and Dodd Klarman used the phrase value investing or value investors more than 60 times.
60.
More than 60 times. That averages out to more than once per page in a dense academic preface.
And that high volume of usage just reinforces the psychological puzzle. Why does this person of high intellect, who clearly thought about every single word in his analysis, fail to apply that same critical thought to the very phrase that Munger and Buffett explicitly rejected?
It solidifies the myth for an entire generation of readers who see that book as gospel.
And in a final, cyclical repetition of history,
it comes full circle. The source highlights that the 7th edition of Security Analysis is the first time in history that the phrase value investing made its way into the book's subtitle. It mirrors exactly what happened to the intelligent investor decades prior. The myth, rejected by its own founders, is now perpetually cemented by those who claim to follow them.
So, what does this all mean? We've traced the history from Graham to Munger. We've established their denouncement of the term, detailed the logic of redundancy, and shown how its continued use, even by brilliant successors like Klarman, structurally distorts the market definition of investing.
At the end of the day, the key takeaway is that the difference between calling yourself an investor and a value investor is not just semantic. It's a necessary logical distinction that protects the purity of the term investment itself.
How does it protect it?
When you just use the word investor, you implicitly commit to the principles of intrinsic value, safety of principle, and cash flow analysis. That commitment acts as a guardrail. It immediately excludes pure speculation assets that generate no cash flows and whose value rests entirely on buyer whims from the conversation.
And this knowledge is highly valuable for you, the listener, because it helps you filter market noise. If you can internalize the fact that value is inherent to all genuine investing, you gain the intellectual defense mechanism that Munger and Buffett used their entire lives. You can instantly cut through market narratives, critically assess every new asset class, and clearly understand the stakes in regulatory debates surrounding digital assets and other speculative instruments.
It allows you to focus on the fundamental task, which is deploying capital into productive assets that generate returns rather than chasing psychological fads. It brings clarity back to a very confusing field.
And that leads us to our provocative closing thought for you to mull over. If the only rational goal of genuine investing is, and always has been, to find value sufficient to justify the price paid, what happens to the market? And critically, what happens to the definition of risk that academics try so hard to quantify? When the collective human tendency to forget the brutal lessons of a true recession resurfaces, and the enduring, profound desire to simply preserve capital takes precedence over speculative short-term gains.
When the tide goes out, only intrinsic value remains. Think about the implications of that clarity in the next downturn.